What smart families know about tax-free charitable giving. Wealthy never donate cash. Why not? It's the most expensive way to give. Instead, they use tax-free strategies. Let them donate more, pay less in taxes, and keep more for their families. Today, we're going to show you how it works. As CFPs, we've helped countless families save millions of dollars planning for charitable giving. A lot of our successful clients want to give back, and we always say, if you're going to give back, we may as well make it as tax efficient as you can.
Very few of them give cash.
Right. And knowing the difference between writing the check and giving other things and other strategies makes a huge difference. And what it allows them to do is give even more money.
I mean, the government's made it easier for them to give other things than cash. So take advantage of it.
And even with all the tax law changes over the years, this has been one of the sacred cows. And I guess they know that if people don't give to charities, the government's going to have to bail them out. So maybe it's a less expensive way of governance.
Absolutely their mindset.
Most generous families think that they have to make a decision between giving money to charity and protecting a legacy for their family. And that's not exactly true. The hidden truth is that you can actually do both. And proper planning for giving can make a huge difference where you can keep more money in terms of taxes while being even more generous.
And often they end up wealthier.
Right. And they don't, as we said before, they don't donate cash. They donate appreciated securities. They use trusts. They use other strategies that are layered to eliminate taxes and maximize the impact both to the charity and to yourself. So if your CPA is telling you, oh, don't worry, save the receipts, that's probably kindergarten planning.
This video is for educational purposes only. Always consult professionals before making legal, tax, and investment decisions.
According to Giving USA, in 2023, Americans gave nearly $500 billion to charity. Think about that. But probably many of them left billions on the table in terms of saved taxes.
Yeah, and with the market where it is the last couple of years, that's probably $600-700 billion.
So the tax code offers a lot of strategies. We're going to focus on 4 of them today, where you can increase your giving and increase the benefits to yourself. Let's take a simple example. We'll talk more about this later. But if you were going to give some charity, let's say your alma mater, you were going to give them $100,000, obviously to pay a new football coach or something. You might want to do that in appreciated securities or stocks, for those that you aren't familiar with the term. And we're going to look at the impact. It makes more sense in a lot of cases than just donating cash. And those that are on the wealthier end of the spectrum that would be more inclined to give usually have appreciated securities of some sort. They have some form of wealth that allows them to be so charitably inclined. So let's reveal the 4 strategies that we're talking about. The first one is called qualified charitable distribution. You don't hear much about them.
It's relatively new.
Relatively new, but you'd think you'd hear about them. Now, hurdle number 1 is you must be 70.5 years old. It's not the year you turn 70 and a half like a lot of the other IRA rules. You have to be 70 years and 6 months and a day.
So let's first establish it's done with IRA assets, and you have to be 70 and a half years old, which confuses some because the new RMD rules are 73 and 75.
And RMD is required minimum distribution, the amount the government makes you take out.
But they kept the QCD at 70 and a half. So you can use your IRA prior to your required minimum distribution year for qualified charitable distributions.
So basically what you do, the rule started with $100,000 as a maximum, and it's been indexed for inflation. But it allows you to give money. If you give money directly from your IRA to the charity, whether it's your church or your alma mater or some other 501c3 organization, it never shows up in your income tax, and you're using pre-tax dollars to do it. If you're in a high tax bracket, it could be meaningful. And with the current deduction rules, there aren't that many people that are itemizing their deductions for charitable giving anyway. We find it to be a great way to give.
And when you get to the age where you have to take required minimum distributions, an example, if your required minimum distribution is $40,000 and you do a QCD for 20, then you only have to pay taxes on the other $20,000 that you take out. It reduces the tax impact of your required minimum distributions, which is problematic for a lot of people.
And is it a little bit more of a nuisance for advisors? I suppose it is. We feel it's part of our job. it would be malpractice in my mind to not allow clients or help clients doing it.
The reality of it is once you have it set up the first year, it's really simple to perpetuate it. So it's a little bit more work. A lot of times we'll have clients that'll go to the guy at church who's in charge of the finances and tells them, I won't be hitting the plate every Sunday. You're going to get a big check at the beginning of the year. And now it's happened so often, they're used to it. And
in fact, one of the biggest objections that I had from clients was, well, when I go to church, they're going to pass the basket right by me and everybody is going to think I'm not giving, which I think it's a nice thought. It's kind of funny, but that's the grim reality. So what's the next? The next one's appreciated securities. And let's use a really simple example I think everybody will understand. Bill Gates, whether he's the richest guy in the world, he was the richest guy in the world at some point in time.
Well, he would be if he wouldn't have given away all that stock over the years.
And he would probably be a trillionaire, they say. So what Bill Gates does, if Bill Gates sold a share of Microsoft for $500 a share, he would probably pay tax on $499.98. So his cost basis is practically zero. When he gives the stock to the foundation, used to be the Bill and Melinda Gates Foundation, I don't know what happened after the divorce, he does not pay income tax on it, and he gets a charitable deduction for the full amount. If he sold $1 billion of stock, he'd owe, with the Washington tax, probably upwards over 30% tax, state and federal.
Probably over 40.
Okay. And instead, not only does he not have to pay the income tax, but he gives the stock away, and he gets $1 billion income tax deduction. Great strategy. So we have a lot of clients, and whether it's in a building, a car, you hear commercials about cars and boats they usually don't appreciate. But a lot of people will give individual stocks away that have appreciated a lot. And in this rising market, the Apples and the Nvidias and the Microsofts is a great way to do it.
The golden thread today is that wealthy people don't give cash. They give appreciated assets, or they give IRA dollars through the QCD that we just mentioned.
Let's talk about donor advised funds, Sam.
Yeah, so instead of giving directly to a charity, you can put it into a fund. It's like a mutual fund, and you get a tax deduction for the appreciated stock that you put into the fund, and then you can divvy it up in the years that you decide to make charitable gifts from the fund. So you get a deduction up front, the money grows in the fund tax-free, and then you pass it on when you see fit to whom you want to receive it.
Yeah, and what it allows you to do is kind of, they call it bunching. You can bunch the charities in 1 year.
So if you're selling a business or you have a big income year, that's a great year to bunch it, and then you can pass it out in future years when you're in likely lower tax brackets.
And again, we talk about it all the time, but planning this stuff ahead of time is really, really important. The fourth one is charitable trusts, and they take a lot of forms, so we don't want to get too in the nitty-gritty with it. But it allows you to put money, put assets into a trust. Either you take the income from the trust, or your kids get a remainder interest in the trust. But it's another aspect, very personalized, very specific to your needs and goals. So we don't want to dive into it. Again, we say it all the time. Income tax planning is one of the most unique aspects of planning. Your income tax return is like a snowflake. There's not another one like it. So when we talk about tax planning, I think the same thing holds. So we want to be thinking about this, planning for it, evaluate what options might make sense for you.
Yeah, so the trade-off with the charitable trusts is that you get an income stream. For that income stream, you don't get a dollar for dollar deduction.
Or you could get a remainder interest in it, meaning the charity gets an income stream and then your kids or whoever may get something less. And there's life insurance strategies that build upon it. They can be very effective. They're usually, they don't work great for $500 deductions, but it's tens of thousands. If you're in that category, you have a lot more options available to you. Let's tell a quick story that I think it's kind of neat. A client was given stock by his parents, and it was very low cost basis stock, meaning if he were to sell it, he was going to have big capital gains to pay. And he said, Paul, there's some charities I want to help. And it was tens of thousands of dollars. It was almost hundreds of thousands of dollars. And we got out the calculator and we said,
so let's be clear about that. It was given to him. He didn't inherit it.
Right.
So he maintained their low cost basis.
Right. And had he sold it, would have had to pay a lot of taxes. He didn't inherit. So the end result was he wanted to give money, and he didn't care what he gave. He just wanted to, he's been successful. He wanted to benefit others. And what we ended up doing is we ended up giving a large portion of the appreciated stock to the charity. He got, over a couple of years, he got really big tax deductions, and we converted nearly his entire Roth IRA by doing so.
So the tax cost of the conversion was paid for by the tax deduction from the gift.
Now, it wasn't dollar for dollar, but it made a huge impact. And
Made
then
it a lot easier.
for him, he, $1 million Roth IRA that will benefit him for his lifetime, and then he can pass it on to his kids. He's 2 kids. And the best part, we talk about this a lot with charitable giving, get an article in the newspaper. Sometimes clients say, when I die, I want to give $100,000 to the church. And one of the things we'll think about, and I think this is good for the listeners, if you give it now, maybe there's a stained glass window or a pew or a something or other, and there's a little plaque. It says Paul Marrella, in memoriam, or donated by. And it's a nice thing for people to be able to do. So I think
Even a letter or a handshake or just a thank you goes a long way. If you do it when you've already passed on, that's not.
I have
not gonna
another.
happen.
Oh, by the way, another side note: if you inherit an IRA, you can use those inherited IRAs for qualified charitable distributions. I think that's an important note. And the next story I was going to tell is about a client who has an inherited IRA. She's converted her whole IRA to Roth, and she uses all of her required minimum distributions. She does it in the fall. She says they get badgered by the charities in the fall. I wait till the fall and I give them my entire RMD. It goes to 9 or 10 different charities. In fact, she just sent me an email the other day saying I wanted to add another one. So what do you do next? If you're charitably inclined, you identify the assets that might fit in a situation like this. And then you try to calculate your potential tax savings. You can work with your professional, your advisor. You can work with your CPA to try to do this and think about getting a plan for maybe not just this year, but maybe next year and the next year and the next year. So charitable giving doesn't have to be a tug of war between your family and your causes. You can do both, and it's about the tax code and using the benefits of the law to maximize the gifts and maximize to the benefit to yourself. It doesn't mean you're any less generous by doing so. You're just playing by the rules. And when you do it strategically, we think it can make a big difference, especially when you're looking at it over a number of years.
It's always nice when you realize the government's paying for a lot of your donation through.
Yeah, but again, the charity's still getting a big benefit from this, which is obviously goal number one. It's not about avoiding taxes. It's about being generous, giving back to those who may be more fortunate, and just playing by the IRS rules.
Instead of giving money to the IRS, you're giving it to your favorite charities. Is really the way that breaks down. Investing is the easy part. Keeping the IRS's hands off requires knowledge and understanding to create an actionable strategy. You've mastered the giving aspect, but wealthy families use an entirely different tax playbook. Our next video exposes which code you're in and how to switch. Click to watch now.
Are you giving over $10,000 annually? Get your charitable tax strategy, book a call below.